everyone. Thank you so much for joining us. We're going to give it a few minutes to let some other people hop on. So just hang tight with us for a few minutes and we'll be right back with you. Okay, I think we're ready to get started. People will probably hop on as we get going. So good morning again, everyone. Special thank you to our panelists for joining us today. Those of you who are attending, if you have questions, please enter them on the right-hand side in the dialog box, and we will address them at the end of the presentation. So you can email us, you can text message us, or you can put it in that dialog box, and we will make sure that we hit it at the end. So I'm going to turn it over to Chuck now for a quick introduction, and then we'll get started.
Good morning. Thank you, Melissa. This issue of private equity is discussed a lot in our world. There's a lot of confusion about it, uncertainty, some trepidation. So we thought that it would be a good idea to have Kristen and her team kind of level the playing field a little bit. They are subject matter experts. Kristen, as some of you know, is also a associate member of MCA and a volunteer for our organization for an important committee. So I'm going to turn it over to Kristen and her team, and thank you all for joining us.
Thanks, Chuck. For those of you who don't know me, I'm Kristen Bailey. I'm a CPA and shareholder at Katz Abash. We're a CPA and consulting firm that specializes in construction contractors. And we're thrilled whenever we can do an education piece for MCA. Today, I'll be facilitating a discussion about private equity in the construction industry. And this is something we've definitely seen some increased activity in with our own clients. Like Chuck and Melissa said, if you have a question for the panel, type it in the discussion or the chat box, and they will be monitoring it and ask them at the end. On our panel today, we have Patrick Lowry. Patrick is Managing Director of Business Valuation at Evergreen Advisors. He has over 20 years of experience in complex business valuation, estate and gift planning, and transaction advisory matters. We have George Manthos. He's a founding member of his law firm. He has extensive experience in entity choice and formation, mergers and acquisitions, private placement of debt and equity, and complex joint ventures. We also have Tim Ward, my colleague from Katz Abash. He's a director with us, and he has many, many more years of experience than I do in assisting construction contractors with business and strategic planning. So thank you for joining us today, panelists. Pat, why don't you kick us off by telling us a little bit about what you're seeing in the marketplace today?
Sure. So first, I just want to thank you, Kristen, and thank you, everybody, for the opportunity to talk today. As Kristen mentioned, I'm the managing director of Evergreen's Business Valuation Group. And we pretty much are hired to do valuations whenever somebody has a need for an independent third-party opinion of value. And a lot of our work is for compliance purposes, estate and gift. It could be a company wanting to implement an ESOP or somebody wanting to sell the business. In terms of our involvement on the private equity side, that really falls within what I would call transactional support. So where George is more involved in the front end of the deal, we get called in with the audit team when the deal is complete, and we're asked to, okay, well, we bought this company. What exactly did we buy? What are the intangible assets? What are those worth? Does the deal make sense in terms of the price and the consideration paid? And a lot of the issues that we see in that process tend to be, and I'm sure George would agree, the valuation of the earnouts and also seller rollover equity issues. So what we're doing is actually kind of trying to clean up and get the company ready to report for GAAP purposes with the audit team, supporting the transaction after it's complete. So within that process, I get to look at a lot of data after the fact. And what I'd like to do today is kind of walk through some of the private equity data that we see based on the databases that we subscribe to. And if you could page to page 3 on the presentation. We'll start with that slide on page 3.
I'm working on 1 second.
Sure.
I'm pausing for something. There we go. It's not letting me.
That's 2. Yeah, you're moving.
That's weird. Okay, we'll just do it like this then. Can you see it?
Yeah, that's page 2. One more down. There you go. Great. So as I was saying, one of the data sources that we subscribe to for private equity deals is GF Data. And what GF Data does is aggregates transaction deals from 250 subscribing private equity firms. And the data that they get are basically deal prices, operating metrics such as the EBITDA of the acquired company, the multiple of the transaction multiple, value to EBITDA, debt levels, that was the amount of financing in the deals, total financing, senior debt financing, and also other information. What are the rates, what are the interest rates on the debt, and other types of legal information, indemnities and insurance caps and things like that. So it's great information. Like when we're looking at this, it's more from a broad perspective and a support perspective if we want to support from an audit perspective, as opposed to, well, this is a multiple that you necessarily derive for a specific company, but we can get general information from this and trends. So as you can see, this is a quarterly breakout of the number of deals that GF Data has tracked for the last 8 quarters. And on the top row there, it's the number of deals. Second row is the multiple value of the deal compared to the EBITDA of the company acquired. Third row is the debt to EBITDA multiple, and then the last row is the senior debt to EBITDA multiple. And what GF Data was suggesting is that in the 4th quarter of 2021, that these metrics are pretty much a return to normal that we're seeing after the COVID kind of drop off a bit. The valuations have come back up, and you can see we're back up to about 7.5 times EBITDA on average. And essentially these multiples, the higher multiples, are being paid for above average performers. And how they describe above average performers is a company that has a growth rate and an EBITDA margin of 12% or higher. has to be a combination of those two. And what you see when you start drilling down in this data is that's very consistent. The private equity groups are very interested. They'll pay higher multiple, but you have to have higher growth and higher margin in combination. So we also saw in this data that the seller financing and the earnouts that I spoke about earlier have decreased a little bit from 43% in 2020 to 38% in 2021. There's still a pretty big component of this population of deals, but as the advantage goes to the seller, some of these contingent payment mechanisms have dropped off a little bit, but they're still very heavily included for the smaller deal sizes. And the last bullet point there is the total debt levels have gone back to where they were before the pandemic. And as you can see there at the last quarter, fourth quarter 21, the debt ratio to EBITDA has climbed up to 4.2. It's actually higher than at any point in the last 8 quarters. I think maybe the high point might have been 4.5%. So big picture here, we're getting back to normal in terms of the general market. Pricing has been increasing, and PE companies are willing to pay for better performance. Next slide, please. So another slice of this data shows you the same transactions cut across different size parameters, and the small size parameters from $10 to $25 million deals all the way up to $100 to $250 million deals. And the biggest thing that sticks out, and this has been very consistent since I've subscribed to this database, is the premium that private equity groups are willing to pay for larger companies versus the smaller group. And you can see in 2021, that size premium was 2.8 times in terms of the EBITDA multiple. So, you know, the large group on average is getting a 9 times multiple. The small group in 2021 is getting a 6.2 times multiple. Another thing to note is, you know, it's pretty consistent on the small side. 6 times or less is pretty consistent for a $10 million to $25 million deal. And in the $100 million to $250 million range, 8 to 9, closer to 9 seems to be the average. And clearly these are just averages again, and depending on the company and the strategic fit and platform, it could be higher. You know, you could obviously get into the double digits in terms of multiples, and it could be lower on the small sides, you know, 4 to 5%, just depending on the specifics of the company. So buyers are continuing to pay up for larger companies, and it's pretty obvious in this data. And even during the COVID year, this phenomena remained consistent. There's a little dip down in the multiples that you see in that year, but it's, you know, looking at the whole year, it recovered quite a bit in the last 2 quarters. So it kind of, you don't see the big drop off in the second quarter or the third quarter of the year that happened here. But again, the size premium is something that is consistent throughout. Next slide, please. Slide. So this is just a chart showing the average multiples and deal volume over the last 5 years. And as you can see, that the deal volume kind of steadily trended up, plateaued during the COVID year as it recovered towards the back half, and then kind of spiked up a bit in 2021. And the thing that I kind of notice is in this space, the multiples on average, really, it takes a lot to move them one way or the other. They're pretty consistent. Like, unlike what you see in the public space where stock prices are going up and down, you know, in the private equity deal space, on average, the multiples don't move that much, although you see a little bit of a spike in 2021. Next slide, please. Let's see if I can see that. So in terms of how the data looks for mechanical contractors. Similar to the general data, the valuations range from 5.7 times to 9 times from the small to the high groupings. And interestingly, in this group, you have a higher size premium going on. And I think that's due to the sector having more advantages of scale versus some others. You have a ability to take care of, reap some synergies at the larger sizes with scale of employees and customers. The average valuation is about 6.5 times for this group. And in 2021, the multiple bumped up to 7.3 times. And again, that's just an average. I'm sure George has seen deals north of these numbers. And one of the key things I wanted to point out here is that on average, this group shows 19% trailing 12-month revenue growth. And these are the types of deals that, private equity groups are attracted to, with EBITDA margins of 18% or so or higher. And these are just averages. So in order to kind of play in this sandbox, you really have to be an above average performer, both in profit and in growth, if you want to above average multiple. Next slide. So the last thing I wanted to talk about is just generically from this data, you can see, obviously we talked about growth and profitability. That's going to result in a higher multiple just by looking at the raw data. You can see how that plays out. Companies in general, private equity groups in general are going to pay more for a recurring revenue stream. If you have a lot of these recurring monthly service contracts, that's going to be a plus. In general, the commercial side of the business is going to be a little more attractive just based on the longer term contracts. The more licensed individuals you have, it's going to be a plus, more attractive to buyers. And then to the extent that you can get rid of key person risk, I know some companies have a CEO that's very involved in the sales process or involved in the operations. To the extent you can kind of extract that person away, set up a more bench strength, that's going to strengthen your company going forward. So that's really all I had for my planned comments, and we can kind of go into the Q&A section.
Great. Thank you. George, can you walk us through like a typical life cycle of this deal and maybe touch on the 3 main strategies for private equity? That's a big question.
Sure. And again, thank you to the MCA for hosting. Happy to be here. As a precursor, we've had as a firm collectively well over 150 years experience doing transactional work in private equity. And frankly, I've probably done more than $1 billion in the contracting, mechanical contracting, industrial service space, private equity and M&A backed. And what I can tell you is, every deal kind of has a flow to it, but the pieces within the flow, are always different. A lot of times when you're dealing with private equity funds, the question is, are you what we call a platform company, or are you what we call an add-on company? And that's not disparaging in any way, and it doesn't always translate into multiple in your business or valuation. What it basically means is a platform company is something that a private equity fund looks at and says, we want to get into this business, and we are going to buy this company as our anchor, and we will go out subsequent to that and buy more companies and combine them with this company. An add-on company is one of those companies that gets bought and added on to the platform company. And it's not atypical where an add-on is brought in due to the fact that the platform company or the other companies are not in a geographic area. They don't provide a certain service. Sometimes it also includes, we don't have the right key personnel in our system, and this company has the right personnel. So it becomes an even more important acquisition. So the first thing is, for the private equity company is, what's the purpose for making the acquisition? Is it going to be we're going to buy and get into the business, or we're buying to further our business? So the reason why that's important is because typically, as Pat was referring to premium, if you are a platform company concept, you're the first one in the process, a lot of times they'll pay a bit of a premium on it. And the reason why they pay a premium is to attract you into your company, into the fold, and be the beginning of the process. And then what they'll do is try to average down their multiples by maybe paying a little less each time for the add-ons, with the idea that they'll get synergy and they'll get cost savings, and then it will lift them up. So then they'll have, as Pat referred to, that big company to get that extra 2 times multiple on an exit strategy. So the first thing that happens is what type of company are you going to be to the private equity fund? And therefore, it also tells you what type of private equity funds that you may actually have knocking on your door. Are they already in the business? Do they have somebody within the fund partnership that actually understands mechanical contracting, industrial services, residential versus commercial? Somebody who's actually been in the, in a company operating it, or has already owned a company, and therefore they'll talk the talk and walk the walk. Or is this completely greenfield? They want to get in the business, they're trying to ride everybody else's coattails and jump into it. That's the next thing that's really important, is because if you're going to be in business with a private equity fund, knowing that they understand your business is very important, because every business has ups and downs. And it's what I call the truly financial investor, the one that's getting into it because they think it's a quick way to make a buck, or they think they can build something to make a buck. They all want to do that, don't get me wrong. But if they understand the business, they'll be more of a partner to you going forward in the sale. Or if you're selling it off and moving on, they'll be more of a partner to your current employees that you're leaving with the business. So it's really important to understand the experience that a private equity fund has when it's looking to acquire you. Pat made some comments about, indirectly about structures of acquisitions. So effectively, there's cash, there's stock, there's debt, and there's an earnout. I mean, those are kind of the 4 levers that get pulled on any given transaction from a high level. Are they going to pay you cash up front, and how much? Are they going to ask you to at least continue to own a piece of the company after you close? We call that a rollover. It's not atypical for a private equity fund to try to, or require, a seller to take a portion of their purchase price and roll it into the company going forward. The idea being it's what we call a second bite at the apple, that, if everything goes well, you're going to make even more money on the piece that you roll over. It's also the private equity company's way of ensuring your continued cooperation and your desire to see success. Contractual relationships and customer relationships are huge in the industry, and it's a pretty important piece to the strategy of a private equity fund going forward. So it's not atypical to see them require the seller to roll some cash into stock, so that way you're still vested in making sure those relationships continue moving forward. Promissory notes, Pat referred to it as well. Not atypical for the seller to be asked to take back paper, meaning I'm going to give you cash and I'm going to give you a promissory note for a portion of the purchase price. You, the seller, are going to be the holder of that promissory note, and you'll get paid over time. Earnouts, there's nothing special to them other than the following. They are a calculation based upon a formula dependent upon how the company does going forward. If you sell your company with the idea that we are just about to take off and we've got everything in place to really make something happen, well, they're going to hold you to it 9 times out of 10. And that means that part of your purchase price will be contingent upon the ability of the company to perform in the way in which you said it would perform. And earnouts take all sorts of different structures, obligations. We could do a whole webinar on earnouts and the horror shows and the positives of earnouts. So that's the general concept behind a private equity deal, and generally what it looks like, how, and what it is. Private equity deals, depending upon if you have an investment banker or if you're just approached, from the point in time that someone says, yeah, I'm really interested in you, to actually getting a deal closed, 60 to 120 days. 60 to 120 days, depending upon regulatory approval, third-party approvals. You'd be shocked how many contracts a company has that says, hey, if I'm going to sell my company, I need to get your consent to the contract staying in place. You would be very surprised how many of those clauses are actually in your documents. And if you're a government contractor in some way, shape, or form, or you have state contracts, I guarantee you they're there, and it's a whole process, and that could take time. So taking a step back, if you make the decision you want to sell, there's a general process you need to think about. First thing is cleaning up your house. You want to make your house look as pretty as possible to enter into the transaction, which means sitting down with your accountant, your lawyer, and maybe even some of your other business advisors, and doing your own due diligence review of who you are and what you have and where you're going, to assess risks and assess weaknesses. Once you've done that, you will be in a position to build towards going to market to be sold with an investment banker or on your own. But you need to take a good review of your own house first. Believe me, no matter how many times I've heard, we're perfect, there's no issues. Nope, there's always something. And it may not be big, but there's always something. And you need to be able to answer every single question that's asked of you. I don't know does not work. You can always say, great question. Before I answer it, I would like to take another review of a few things to make sure that I'm accurate in the way in which I explain it. There's nothing matter with that. But unless you've gone through and cleaned your house and done your own due diligence review of yourself, you're not going to be in a position to ask those. So once you've identified somebody or a group of people, if you're not in an auction, meaning an investment banker isn't grabbing different people to try to bid on buying you, you enter into the letter of intent stage. The letter of intent generally is an outline of what the business parameters of the deal are. Now, these are not always binding. And the reason for that is that stuff happens and things come up in due diligence, which require the seller and the buyer to reconfigure pieces. Not all the time, but it does happen. So you take the LOI, it's a letter of intent, you negotiate that with the help of your lawyer, your investment banker if you have one, maybe your accountant, to come up with how to move forward and do the structure. Sign it, and you're off to the races. They're doing due diligence on you, driving you absolutely insane because they won't leave you alone while you're trying to run your business. Your lawyers are negotiating the legal documents. The accountants are coming in and out as well, just like the lawyers, to assist with potentially the tax effects, which I think Tim's going to talk about, of any given transaction. I can tell you there's stock acquisitions, asset acquisitions, tax-free rollovers, mergers, F reorgs. I mean, it can get crazy. And this is where having a good legal advisor and a good accounting team can really help you plan your best position moving forward. So you negotiate the documents, you head to closing. Yay, we're closed. 9 times out of 10, there's a breather, but there's still things to be done post-closing, and that's where the accountants can come in. There's audits and true-ups and all sorts of things. But the bulk of the work is done, hopefully, at the time you close. But there's always a little bit going on. And if you decided to stay on or be an investor in the new company, you may be a new board member. You may be asked to be under an independent contractor agreement to assist with the handoff. It takes a little time after you sell a company to get a full handle. You have to understand that. But if you've taken these steps and you proceed in a good and orderly way, and you focus on making your company look the best it can look, you're going to have a very successful transaction and a very positive outcome. Thanks.
Thanks, George. Tim, can you give our audience members some tax things they should be considering when entering into or considering these deals?
Yep. So thanks again for having me. Pat and George touched on several things that I was going to mention, but it definitely the seller would prefer to sell their stock and get the long-term capital gain. Most acquirers want to buy assets. There's a couple things we can do, the 338 H10 or the F reorg that George mentioned is very popular for M&A. If you buy the stock, you can either through the 338 H10 or the F reorg, you can novate the contracts or just transfer the contracts a lot easier than actually novate them and restate them in the new entity. So that's a big plus. A lot of the mechanical contract, any contractor, the licenses is a big thing. So if you do the stock transfer, that makes that a lot easier. And George mentioned the second bite of the apple. So, I mean, we want to definitely minimize taxes. So, I mean, everybody talks about what they sold for, but it's really about what you netted. So if we can structure the sale in the best, most tax efficient way, then you're going to end up with more money at the end of the day. So that's what we spend a lot of time on. And like George mentioned, the true ups, I mean, working capital adjustments, all that, there's a lot of things you can do ahead of time. And I definitely echo what George said about cleaning up your house before. You want to do it before you go to market instead of trying to make things better. I mean, especially when you got an LOI and everything else, you got to make sure you have all your everything in order in your house. But I mean, the main thing for taxes is we want as much to be long-term capital gain as we can. So it's pretty complicated, the F reorgs and all that, but let's get you to the near the finish line before we jump into that.
Thanks. Tim and George, you both mentioned cleaning up, the financial statements or the house before you go to market. Can you give a couple of examples of, typical things that need to get cleaned up?
Well, first and foremost, most companies do not have full-blown audited financial statements. It's just, when you're a private company and you've got a set of investors who may be family, or not even investors, I mean, they're investors, but they're shareholders, they're family members, they're tight partners for 20 years. It's not atypical that they're not audited financial statements. And because of that, the dreaded word, GAAP, they're not always in accordance with GAAP. And why should they be? It's you, your brother, your best friend, your partner of 20 years. You guys have figured out how you're going to do it, and that's the end of it. But it does become a problem when you go to sell it off, especially to a financial investor. So part of what we generally tell our clients to do these days is do a quality of earnings. Bring in an accounting firm to get ahead of the curve, and they will do effectively an audit and review of you and figure out where your weak points and where you're not in compliance with the GAAP. So that way, when you're moving to a negotiation, you've already got all the answers in your hand. I mean, that's a key piece. If you're a real small company, and small, doesn't mean you're not important, but if your revenues aren't, if your EBITDA is not north of $2.5–3 million, most private equity funds aren't going to do a full-blown quality of earnings. It's going to be a more condensed review, but they're still going to do a review. They're still going to get in there and do due diligence. So you need to do it yourself. But if you're over those numbers, getting a full-blown quality of earnings done is important because it gives you the answers going in. And then quite frankly, because everything on that is going to be discovered by the buyer, the private equity fund, just hand it to them. It's their roadmap. And you've already figured it out and you can address everything. So that's a very key point. You know, understanding where your financials are from a gap purpose, or, there's areas that are really big, recognition of revenue in contracting is a nightmare. It is a nightmare. Reserves for bad debt, performance reserves, we all know what they are, where, there's a reservation to the end, retainage. These are all very complicated things that you've got to have a good handle about. And honestly, if you haven't been doing it for 10, 20, 30 years or have a team with that type of experience, the average person, even with, amazing experience running these types of companies, doesn't know all the ins and outs. And having a good accounting team step in at that stage to help you figure out where you're not in compliance and where the flashlight is going to be shown on to, rise to the level of concern to a buyer is really important. Doesn't mean you're doing anything wrong. Doesn't mean that, it's a horror show, but it goes to knowledge and understanding. And Tim and Kristen, their firms like theirs, get in there and help you figure that out. And you need to know it because, as Tim mentioned, with the complexity of taxation, it goes to structuring the transaction as well. And, it's planning the structuring is not something you do after the transaction closes. We need to do that up front, which then means you need to make sure your financial house is at least in order from the standpoint of, whether or not you're living in a mansion, a, split level, a rancher, or a double wide. And what I mean by that is how sophisticated is your financial, records, and how close to gap are you versus, not being there. And it's really important that you work with people like Tim and Kristen on those issues.
Yep, I definitely agree with all that. And then with mechanicals, like service contracts, the revenue recognition for that and the warranties, there's a lot of other things to, you might maintain your books on cash basis, accrual basis, and just make the adjustments at the end of the year. But the private equity firms want to see the gap income throughout the year. So that's where we usually have to spend some time, and definitely on the projections.
Yeah.
I was just going to add to that, if that's okay, Kristen, that agree with all that. And I think I read somewhere where 95% of the Q of E's result in adjustments, and those adjustments are going to be downward adjustments most times. So to the extent that you can alleviate that or stop your discretionary items and run the company more like a public company for a few years before you do the sale, that's going to just reduce the amount of things, because all these adjustments are going to be negotiated. You can have the management adjustments, and that's going to get beat up pretty good. So if the cleaner they are, the easier that process.
Pat, as far as like adjustments to EBITDA, what do you, for normalization of earnings, what type of things do you normally see?
So at this level, where you're kind of looking at larger companies rather than smaller ones, it's typically owner's compensation. There's less of the yacht type of adjustments or egregious type of personal expenses. There may be some benefits that you have to look at also, but I think it might have been George that brought up the accrual adjustments are the ones that are difficult and hard to get your arms around, like the revenue and things like that. But we primarily, and even in the GF data, you see they're all adjusted, and owner's comp is typically the biggest item that you see. There could be some smaller discretionary items.
And then George, you were talking about the contractor doing their due diligence on the private equity side. Is that normally a difficult process? How transparent is the private equity? And should the contractor be alarmed if you're not transparent?
You know, that's a good question. With the internet today, there's so many good things that you could pick up on. You certainly, if you don't have an investment banker, you know, doing the diligence could be a little tougher. You have to rely upon your lawyer, your accountants, and other advisors to help you. But starting with an internet search, right? Like, so-and-so came to me, go take a look at their website, go look at who their own investments are, get a feel for them. Don't do anything on the phone only. Make them come visit you. See what type of person they are. You know, get to know them. You know, if they're the slickster, you will pick up on it pretty quick. I mean, business owners are pretty savvy on what type of people they're dealing with. They wouldn't be successful if they weren't. So do that first. Lawyers and accountants should be able to assist you in getting more background on them. When the time hits, just look at them and say, I want references. I want to talk to other sellers that you've bought over the years in my industry and in other industries. I want to talk to a couple of your current CEOs and other and things like that. You'd be surprised how honest they'll be. They'll be. They'll say, I mean, they may say, yeah, it was a great transaction. Everything worked great, but just know, like, if you don't get this done, there's always going to be something cantankerous or something like that. You'll learn. I mean, it's legitimate. They will talk to you. That's another good thing. If you're the platform company that we referred to, not going to have probably a lot of other company CEOs or targets or sellers to talk to about how they did in your business line, but you'll have other people to talk to, and you can go find out from them what it is. Also, it's not atypical for the private equity funds when they do decide they're going to go off and create a platform, they hire somebody from the business to kind of be their handholder. And so they call them an operational partner. And as an operational partner, it's somebody who generally has experience. So you may actually know who that is. But doing diligence on who is going to buy you, if you're just going to walk away, and that's the end of it, your diligence is about, do they pay? Do you have to fight for it? And do they play games and negotiations? If the plan is, I'm going to take a bunch of my chips off the table, I'm going to have to keep some on the table, I'm going to be on the board, I want to make sure things keep moving forward, I'm going to hang around, I want to be an investor, but I want to keep moving. Then it's all that plus, what do they like to work with? Are they straight? Are they honest? Do they listen? Do they just make all their decisions from a 100% financial point, or do they at least look at the business and what the ups and downs of the business could be and how to plan for that? So you'd be surprised how much diligence you can actually get done on these entities and on these investors.
Thanks, George. I see Chuck and Melissa pop back on. Do we have any questions?
Yes, thank you. Question, you know, I think this is for Pat maybe. As Kristen knows as well as anyone, our members are signatory contractors. So they are, they chosen to become employee union labor. In terms of valuations, you know, the multiples you kind of threw out there, what delta, if any, exists for a union contractor versus a non-union contractor in the market right now?
Yeah, I don't know that you can kind of drill down to that level, but what I would say is if you just focus on the earnings and the growth, they're gonna pay the same multiple. If the company is attractive and it's run well, I don't think it's going to be an issue. And maybe some of the other folks can comment on that, but I don't know how I can delineate on that in terms of valuation.
Yeah, so that's a good question. And I agree with Pat. It's not so much about the EBITDA, it's about the operations. You know, we've done a lot of union acquisitions. We've done a lot where the company was becoming double-breasted, where there was non-union side of the house and a union side of the house. The focus on EBITDA and everything else is the same. Margins can become more difficult with union-based companies at times because of all the different pieces that go into paying, the union, the trust, the retirement benefits, healthcare, union dues. That all factors in, which can reduce EBITDA and can reduce margins, sometimes significantly. So to the extent that that puts pressure on the baseline for the valuation, yeah, it could be paid less. That being said, over the years, a lot more private equity funds have become a lot more comfortable in acquiring union-based companies. There was some really bad case law that came out of the Midwest that took a long time to make its way up to the federal court, where private equity funds could be liable for withdrawal penalties and other things with regard to unions. Not fun stuff. But the cases have come out where, now they've been more or less overturned, and the few guidelines, private equity funds aren't as worried about it. So, there is a lot of action in private equity funds. Unions are now investing as limited partners in private equity funds. So those private equity funds very much are focused on trying to pick up unionized companies. But from a valuation standpoint, they'll pay the same multiple generally on the EBITDA with the margins. It's just that the union costs can put more pressure on those numbers, and thus the baseline is less than potentially with a non-union company.
Yeah, excellent answer. Thank you very much. I have a question from one of our participants asking about how to protect their employees in a transaction like this. How do you protect the employees you really value and care for?
Good question. First off, anybody who's buying your company is more likely to look at it and go, I need everybody, right? That's first and foremost. Even if it's a bolt-on to a platform, they still need people. As a matter of fact, they might want to leverage those people, in order to be able to go after new business and move them around their system. Generally speaking, when you do a transaction, you can negotiate in there, with regard to a lot of it. You covenant and agree that you're going to keep our people on for a period of time. I'll call them the line workers, the lower middle management and the general employees. Generally, they don't have a lot of issues. It's middle management and up, where depending upon the type of transaction, you could start to see some push-pull on who they want to have long-term. But generally speaking, you can get what we call a post-closing covenant, for a period of time to protect certain employees and who's going to get employed. But no, the harder you push on that, in some ways, they can hit you, the owner, with some of the costs and expenses.
Yeah, very good insight. Thank you. And this is kind of related, I guess. Question pertains to being transparent with your employees. You're going through this. Could it cajole some key employees to depart? How do you balance that? Wanting to be transparent to your team, but also, not saying something that might disrupt operations.
Yeah, that's always the problem. And by the way, Kristen and Tim are laughing because they're the ones that end up going in earlier than most. And so the accounting department is either lied to flat out or they're under the tent early. Look, no person's an island and no business is an island. You're gonna have to find that balance. You cannot enter into a transaction and do all that comes along with it by yourself. You will need your accounting groups. You will need somebody from operations. You're gonna need people to assist you in making a transaction happen. And, generally speaking, it's the upper level members of the team that know what's going on, partially because they're either going to be out the door and getting a nice check on the way out the door, or they're getting a nice check, they're sticking around, getting a new contract and new opportunity. Plus, they can help you do all the things you need to do. So it is a delicate balance. You're going to have to surf the waters. There's no other way to say it. But no, frankly, no, your accounting groups and your high-level team are going to know and should know sooner rather than later once you decide to move forward.
Very interesting. You mentioned something about, I thought it was, maybe it was George that talked about cleaning up your house. I remember I spoke to a gentleman down in the DC area who sold his company, and he didn't think about the cash that was sitting in the operating account. And what a strategic mistake that was, that he just didn't even think about it. And when he got to closing, he said, okay, well, whose cash is that? And it became a very problematic detail that, again, to your point about cleaning up your house, anything that you see that obviously you need to use a professional with this. This is not, these our business owners have given their blood, sweat, and tears, and they can't do this on their own. They need to rely on professionals like yourself. But any crazy stories you've heard like that, gentlemen? You've probably seen it all, I'm sure, but that was, what an easy thing would have done to move that cash out of there, with some planning. Any crazy stories you want to share?
I think Tim probably has a few, just like I do, and Patrick's probably seen them when the arguments are going back and forth for who's paying for what. I think, and I'll let Tim talk about, net working capital and cash, because it's really what you're talking about. Like, when someone buys your business, they're buying a going concern. And when they buy a going concern, they expect a certain amount of net working capital in the business. It doesn't need to be cash, but cash may be a component of it if you don't have what you need. I guess part of cleaning your house is making sure that any personal items, I would go so far as say, any personal items that you believe shouldn't be with the business or stay with the business should be pulled out sooner rather than later. And as part of the Q of E and the review of the records, financial records, you want to make sure you take care of that up front so they don't show up on anything. I have seen some really crazy fights over Baltimore Ravens tickets. I mean, just crazy, going at it. I mean, like going at it where the acquirer wanted them to stay because he's been on the wait list for a PSL for eons. Artwork shows up, which is really bizarre. People don't spend a ton of money on that stuff, but some businesses, they get large enough, and they're dealing with some serious, partners out in the place. They have nice offices. Artwork fights. Cash is always an argument, whether or not it's retainage. Is it a security deposit? That kind of stuff. I think, I'll kick it to Tim, from the standpoint of when you're dealing with, what's on your books versus what you got to turn over.
And that's the big thing. I mean, the working capital, we hone in on that right away. That's a lot of, because of bonding and everything else, a lot of contractors need to keep a lot of cash on hand. So that's a huge thing. And the acquirer would like to get as much of that cash. You're paying dollar for dollar basically for that. But so that's always an argument. But the biggest thing of cleaning up the house is most contractors are trying to minimize tax every year. But to make yourself looking more saleable, you really want the opposite. So you want to show more profit. So that's the balancing act, I think, with cleaning up the house and getting ready for the Q of E, and then get to Q of E early and try to make adjustments. So when you get to the seller or get to the buyer, the transaction, you're ready for it to show them that you put these things in place.
And one other thing to mention on the working capital is, that should be in the letter of intent, the working capital, the minimum working capital, and what to do with excess working capital, and also retainage. Is retainage working capital or not? And if it's not, what happens to that retainage that's collected post-closing?
One thing I was going to add to the cleaning up of the house is I've seen employees that just can totally screw up a deal just because they're not happy. And you want to take care or make sure you either deal with that situation ahead of time or make them happy some way or not, or let them go or whatever needs to be done. But it's definitely happened in the past. I've seen that happen. It can really ruin things.
Thank you. Maybe take two more questions from the participants. How often is real estate a part of a transaction?
It's not atypical. Really depends upon the nature. I mean, we see it all the time where there's either the real estate goes or does not go, and it's subject to a lease with a maybe a first right of refusal or something like that. Most private equity funds are not in the business of owning real estate, so they don't want it, which is where, you know, it gets spun off and stays behind, but subject to a lease. And the lease could be very profitable. I mean, you know, it's something that, you know, when you're dealing with the accounting firm and your investment banker / valuation team can help you with, you know, just making sure that the adjustments to your books and records for purposes of doing valuation takes that into account early on. And then, you know, frankly, I'd, you know, spin it off before you do the transaction to a separate entity if it's a company. So that way either it gets sold or it doesn't get sold and you get a lease and you got mailbox money for the next 5 to 10 years.
Yep, and we've always recommended to keep the real estate separate from the operating company. So it is a good, another source of income for the owner selling. So, but you definitely want to factor that rent in and for the projections and the quality of earnings.
Excellent. And I'm going to let, since my vision is quickly getting worse and worse every day, I'm going to let Melissa read that question that's up there.
So the next question, how does one go about getting a job opportunity as an operational partner?
Well, if you've had a successful exit on your own company, you're more likely to be grabbed by your private equity fund or somebody like that who you were working with to help them future. You know, outside of that, look, to be an operational partner, you either had to have had success, been a part of a team that was successful, or have a long history of being in that industry. And ways in which to deal with that is you do a little research, get online, see who's investing into those areas, and then also go take a look and see what conferences are out there and what events are happening and do some networking and have, you know, talk to private equity fund, you know, team members and see who their portfolio companies are. And you got to network that. Absent, you know, having a successful venture, selling to a private equity company, or, you know, being in a private equity company and it sells, the way in which to get in around these guys is through networking, as well as, you know, your lawyer, if they've got connections, you know, and you're interested in getting to know some private equity funds, they can make calls. Same thing with the accounting firms, same thing with the investment bankers and valuation teams. But the number one way in which to do it is be successful. And you know, success begets success. They will seek you out because they will think you have the magic sauce.
Excellent, thank you. This has really been a tremendous presentation. I've been to national conferences through the MCA. In terms of private equity, the minutia, this has been as good or better than anything I've seen. So I really appreciate that the team that's put this together. Kristen, really just as always, home run advice. If you know, yes, private equity, that's something that you all have subject matter expertise in. It's clear that, you know, you're experts, but the range of services that you offer clients goes way beyond that. If one of our members has an interest in you know, getting an opinion, getting some advice, what's the best way to reach you?
I think everybody that attended this will be receiving a follow-up email with our contact information. So they'll have George and Patrick's and Tim's. So is email good for you and George and Patrick?
Absolutely.
Sure.
Excellent. Anything else?
No,
Melissa?
think we're good.
Okay, great.
Okay.
Thank you very much. I really appreciate it. And everyone have a great day.
Thank you so much.
Take care. Thank you for having us.
Thank you.
Okay.
Bye-bye.
Bye-bye.